Welcome to the Money Mastermind Show. Let's talk money.
Welcome to the Money Mastermind Show. Tonight, we are talking real estate, specifically how to invest in it and how to start. With us to discuss this is the usual cast of the Money Mastermind Show, our panel, the actual Money Mastermind Show, and that is Kyle Prevost of youngandthrifty.ca, Miranda Marquette of Planting Money Seeds, Peter Anderson of Bible Money Matters, and Tom Drake is usually with us from the Canadian Finance blog, but he wasn't able to make tonight's show. I am Glenn Craig. I'm from Free From Broke, and I'm moderating tonight. With us, we have a special guest. We have real estate expert and author of the popular real estate site Bigger Pockets. We have Brandon Turner with us. Welcome to the show, Brandon.
Hey, thank you. I am pumped to be here. This is going to be fun. I've never done something quite like this with so many people. This is cool.
It should be fun. I mean, they tend to be.
Yeah.
So, for those that are out there, if you're watching us on the events page, we do have a questions app. So feel free, if you have any questions about how to start on investing in real estate, please feel free to ask those questions because we love to answer viewer questions. So now to the show. We are talking about real estate investing. I know I've heard lots of stories all over the place about how many people build wealth through real estate. Like that's one of the main ways that people can do it. But as a homeowner, at the same time, that seems pretty scary because sometimes just owning a home itself is a handful. So, how does a person start going into investing in real estate?
Sure. All right. So the first thing I will say is that real estate investing, in my opinion, it gets confused sometimes because there's two things. There's like real estate job and there's real estate investing, right? So the house flipping TV shows that we watch on TV sometime, they're a lot of fun. I love watching house flipping shows. That's what a lot of people think of when they think real estate investing. But technically speaking, that is just a business, right? Like it's like selling Tupperware or whatever, right? You have a product and you sell it. You buy it cheap and sell it for more money. So I guess the first thing I'd say is make sure if you're talking about investing, you're actually talking about investing, I guess. So the idea of like rental properties or somehow putting money out there. I'm not saying you can't flip houses. I love flipping houses, but they are different. So I guess the first thing I always tell people is know what you're getting into and that you are getting into investing. That's kind of a good way to start, I guess. And then you kind of asked to like getting started. I guess it gets overwhelming. You said, especially being a homeowner. So that's the other side of things is owning a home is very, very different than investing in real estate, largely because of the emotional stuff, right? I mean, for those of us who own houses, it's an emotional like process to buy them. It's an emotional process when something goes wrong. Everything's emotional. When you're investing, everything becomes a lot less emotional. It's all about numbers. So I don't know if that answers your question a little bit, but
so how, for the audience, how does investing in real estate actually build wealth? You talked about flipping a house. And I think that in itself is a little obvious. You buy a property, you fix it up a little bit, and you sell it for more. Almost like you buy something at a garage sale, fix it up, and sell it on eBay almost. Obviously, there's a lot more involved there, but it's that type of process. But I think that's probably the smaller niche of what real estate investing is. So for the people out there, what is it that actually builds the wealth that everybody talks about, how important real estate investing is?
Sure. So there's four things, and let me hope I get these all right today. There are four things that actually build wealth with real estate. Number one is appreciation. So that's like flipping houses, right? You buy something and it goes up in value. Whether or not you force it, like flipping, or if just the market goes up, great, right? That's called appreciation. That's number one. Number two is cash flow. That is the extra money in your pocket every month. So you spend $1,000, but you brought in $1,200. You got $200 cash flow. So that money comes in. That's the other way. There's tax benefits. When you own rental property, like before there was about a 3-year period when I didn't have a W-2 job, and I just lived off my cash flow, and actually paid $0 in taxes, nothing, even though I made a good income. But the government, at least the U.S. government, loves real estate investors, so they like lavish us with rewards. Like, thank you for giving our population, places to live. We're going to give you good stuff. And then So like there's a lot of cool deductions. And then fourth is the loan pay down. So that what that means is, let's say you had a rental property and you never made a penny on it. Every month you just broke even. For 30 years you broke even. But if you had a mortgage on it when you started, after 30 years your mortgage would be paid off to nothing, and you'd have a house that's, you didn't have to spend $1 on. Over 30 years would get paid down. So those are like the 4 ways that real estate investors make money, and some more, flipping is a lot more appreciation. I focus more on the cash flow side of things, but all 4 of those do play into every real estate investment.
So that loan pay down really plays back into that first one, appreciation. Also, it's just a longer term.
Yeah,
it's like like buying a bond. You sit on it for like 20, 30 years, and
yeah, and hopefully, someday it's going to be much better than it is today. And again, like I have a property right now that I lose money on. Essentially, I kind of like I lose a little bit of money, then the property value goes up a little bit, but really I'm breaking even. Yet at the end of the day, I'm like, well, I don't really care that much, because 30 years from today, well, actually I'm down to like 24 years from today, that thing will be worth $150,000, and I didn't have to save $150,000, right? My tenant paid my savings for me. The tenant made that payment every month, and that kind of went into a savings account that I can't access till I sell the property. So that's kind of that loan pay down, and it's kind of fun.
Right, and I think you make a good point when you say, I think that's a good distinction to make when you say, the loan pay down aspect of it, because I think a lot of people immediately glom onto the idea of, oh, well, that's what's happening with my own house that I live in, and really it's not.
Yeah.
And so I really like how you qualified that with having the renter in there, and they're paying that for you. When you're paying your own mortgage down, that's not the same thing.
It's not. Yeah, when you're paying your own mortgage, it's just like a forced savings plan. So I don't even advocate people should buy houses. If you want to buy a house to live in, great. I bought my own house, but I don't think that a person is going to build that much wealth owning their own house. It's a decent savings tool. It's an asset class, I suppose, that, does okay, but I don't know. I bought a house because I wanted to be able to put a hole in the wall. That's a true story. I bought my first house when I was 21, and I took a hammer and I just went bang in the wall and put a hole in it because it was mine and I could. But that's about the so.
Were there celebratory drinks on the occasion of buying your first home?
I don't think they were involved in that one, but that was I don't know. There was something about having my own house that I lived in apartments for so long that I was just pretty ecstatic to be able to do what I wanted. And granted, there is something. Okay, so if I always say, buying your house doesn't necessarily matter that much in terms of building wealth. However, there is a concept that I always talk about. I'm a huge fan of it. It's called house hacking. I invented that term, so you guys can go ahead and use that and pay me a royalty. But the idea is, if you can combine your house with one or more of those 4 investment things, everybody who owns a house gets the tax benefits anyway, but or somewhat anyway. If you can combine the other assets, you have to do some special things, but you can, owning a house, they give you some benefits. But if you can capitalize on those other benefits of real estate, like cash flow appreciation, now you ask, how do you do that? Well, a couple ways. One, my very first house, the one with the hole in the wall, I fixed it up. I put some, sweat equity into it. I, remodeled the bathroom, put new carpet in, and I sold it, and it made like $20,000. That was my first adventure into real estate, and I was like, that was amazing, right? So I took that money and then I invested that in a new property. So I kind of hacked my housing or hacked my investment. I didn't have to do a lot other than, hard physical labor. The other way was the next property. I bought a duplex. I lived in half of it, rented the other half out. The other tenant paid, I think they were paying $650 a month for rent, and my mortgage was $620 a month. So I was living for free. So again, that's kind of the cash flow thing. I was actually being able to live for free. I was using my home as an investment. So there is that strategy, and I think that's probably those kind of ways are the best way to get started with real estate, especially if you're younger or you don't have a lot of money. Those are just really good ways to kind of get started.
Now, Brandon, I actually have a post on my site that you wrote from a couple of years ago about that duplex.
Oh, really?
And it talks kind of I thought it'd be an interesting story to tell about the famous former resident of that duplex. I don't know if you know what I'm talking about.
Yeah, I do. So that house we found out, so we bought the property, we bought the duplex, lived in half, rented the other half out. It was actually 2 houses on one lot, so it wasn't attached. They're 2 separate houses. And I lived in this little, one-bedroom house in the back, in the front house. Anyway, my tenants for a couple years complained or just kind of made passing comments about that there was like flashes in the windows, just like flash, like at random times, day, night, whatever. They noticed that like weekly there would be flashes, and nobody knew what was going on. I figured the city was doing some kind of weird, assessments or appraisals or something, and it took us about, I think, 3 years before we figured out when some Swedish tourists knocked on the door and they wanted a tour of the Kurt Cobain house. And so what we found out was that, what we found out that Kurt Cobain, when he was born, his parents lived in the little one-bedroom house in the back. So, like, he was born in a hospital, of course, but his first house was the little one I lived in. Then he moved when he was 6 months old to the front house. And he lived there till he was 2 years old, and then he moved. And so I'm probably the only person alive that can say that they own 2 of Kurt Cobain's former houses. So that's my claim to fame. And what that gets me for rent is absolutely nothing, and it's nothing other than a good story to tell. But
Nice.
yeah, I think I mentioned in that post on your site though that like the cool thing about that is not so much that it was a former rock star lived there, because I don't get anything out of that. What I get is cash flow every month. Because I bought that property with almost nothing down, because the government loves to give homeowners cheap loans. So I bought that with very little money out of pocket. And then now when I moved out, I just kept that as, turned it into a rental. So now I make I think I'm at like $250 to $350 a month every month for as long as I have that property. And someday the loan's getting paid down, and someday that'll be zero, and all of a sudden my cash flow will go from $250 a month to like $750 a month, and I'll have the entire thing paid off free and clear. Just kind of in time for retirement. I was 21 when I bought that, so 31, 41. I'll be 51 when it's paid off. And so if nothing else, if I worked at, McDonald's for the rest of my life making $8 an hour, I'd still have all these loans paid off and have about $1 million in equity by the time I'm ready to retire. So that's kind of how that loan pay down is a cool way to make wealth in real estate.
Would you say that's kind of an ideal situation for somebody who's just getting into the real estate investing, is buying an owner-occupied multifamily dwelling like a duplex or a triplex or whatever, and getting the good financing for that because of the owner-occupied part, and then having less risk with your own mortgage because of that, and various other things.
Yeah, I mean, definitely. I love that strategy. I love it because, so for one reason, you can buy a house for 3.5% down. Like, you don't need a full 20%. Now, I'm not saying you should. I'm saying you can. In order to do that, you better have a really good deal. But you find a good deal that's going to cash flow and give you good money with 3.5% down. You can't get 3.5% down payment on an investment property ever. I mean, you're lucky to get 20% down. Usually it's 25, 30.
So you're talking about using an FHA loan.
Exactly.
Right, to buy a home, and
yep. And they're okay with FHA, and all residential loans are generally okay with 1, 2, 3, or 4 unit properties. The banks look at them all as residential. They don't care how many units are in there as long as it's less than 4 or less. 5 and up, you're in a whole different ballgame, which is we are not going to get into here because that's way more confusing. That's commercial real estate, and that gets fun too. So yeah, but house hacking, love it.
So I want to go back to this Kurt Cobain thing.
Sure.
So you bought this and you had no idea.
No, nobody did. It was a bank repo that was listed for like $60,000 that, was ugly and kind of neglected and hadn't been lived in years.
Sort of like Kurt Cobain. Yeah.
Sort of like Kurt Cobain, right? Like, the story just fits him, right? My whole town kind of fits that. Like, my whole, area is very, I don't know. They're like, we're gonna live like Kurt Cobain lived, and that's as far as they push it. So, now that said, that actually brings up a good point. The duplex idea works really well in my area. It works really well in a lot of areas. It doesn't work very well in a lot of areas. If you're looking at a duplex that's going to cost you a monthly payment of $2,000 a month, and the most you could rent out a unit for is $500, well, then it's probably not going to help you out. You might as well just buy a house at that point, right? So you have to at least find a good deal.
So what are the multiples that you look for then, Brandon? Like, say you're tossing around ideas. Do you have some rules of thumb for people that are just starting out?
Sure. So a couple rules of thumb that I really like a lot. One, now again, these are rules of thumb. They're not don't buy a property based on these. They're just for quick analysis. But one, my favorite, is called the 50% rule. It's very simple. All it says is that all the money that comes in, divide that in half. The money you have left is the 50% is what you get to pay your mortgage with. And anything left over, you get to keep. That's your cash flow. So again, going back to that, if you could rent a property out for $2,000 a month, if you could rent it out for $2,000 a month, no matter how many units it is, you get $2,000 a month. Divide it in half, you got $1,000. If your mortgage payment is $800, you could probably expect to get about $200 a month in cash flow on that property when everything's said and done. It's real general. Some properties are 40, some go up to 60%, but 50 is a nice number that I use all the time, and I find really helpful just to say, okay, this is probably what it's going to end up being is right around here. So anyway, that's probably my favorite. Another one that people use is called the 1% or 2% rule. It basically says, take the property value, like $100,000. Let's say you buy it for $100,000. It should rent for $1,000 a month would meet the 1% rule. $2,000 a month would meet the 2%, right? Because 1,000 is 1% of 100,000 and 2,000 is 2%. So a lot of times people use those numbers, 1% or 2% rule, to talk about how good of a deal they're getting, like how, that price, that rent per property, which is like the PE number. Is that what it's called, right? I'm not a stock guy, but like with a valuation of a company, right? They have those numbers.
Oh, yeah,
kind of similar.
Your PE ratio, yeah.
Yeah, so it's kind of like that, but it's like how much cash or how much income does it make based on the property value. So anyway, 1%, typically anything below that is never going to cash flow, hardly ever. So you buy a property that you bought for $100,000 and the most you can get in rent is $500 a month. That's only 0.5%. That's never going to cash flow. So my bottom is 1%. I'll never go below 1%. Some of my properties hit 2. I even have one that hit 3, and that was an incredible deal. Bought at a really good time. I wouldn't expect to get those anymore. But anyway, that's just kind of a nice rule of thumb. You just say, okay, hey, this one meets 1% rule. Let's look into it more. This one's almost 2%. Wow. So anyway, those are the 2 or 3, if you want to look at it that way, kind of rules of thumb that I like a lot.
So I like that you point out that when you're talking in terms of cash flow, it's different from saying, oh, well, this is my gross. I'm getting $2,000 a month. And rather than focusing on, oh, I'm going to get $2,000 a month, you're saying, dial it back a little bit because you've got all of these expenses, you've got the mortgage, you've got all these, maintenance, repairs. And so I think that's important to remember too. We talked about that a little bit in cash flows. You can't look at, oh, well, what's the gross? You really need to look at, what's actually moving through here.
And to add on that, here's the biggest mistake, the number one mistake that new investors make when they're buying rental properties is underestimating the expenses. It happens time and time and time and time again. They look at a property and they say, hey, it's going to rent for $2,000 a month. My mortgage is only going to be like $1,000. I'm going to make $1,000 a month. And so they buy this property thinking they're going to make all this money. Well, they forget about the taxes, the insurance, the HOA fees if they have them, the the maintenance, the repairs, the city taxes. All those things just add up very, very quickly. And that's why we use that 50% rule, because we say, look, you're going to have half just in expenses, not even counting the mortgage by the end of the day. And so anyway, that's such a huge problem people make, is they look at that, first of all, use that $2,000 gross number, and they say, great, look at all this income coming in. And then, oh, all my mortgages is this. And that just really, really hurts people in the long run. And they end up buying crappy properties, and then they go into foreclosure, and then guys like me come and buy them up for cheap from the bank. And so if you want to buy them, go ahead and buy them. Just know that I'll get them eventually. So.
I think people make the same type of mistake when they're just buying a home for themselves as well.
Yes.
They think whatever that mortgage number is, maybe you need a little bit more and then you're good. But then you buy so much house that it's so tight that, once you need that one repair, all of a sudden you're sweating it out, or the taxes go up and you're sweating it out.
Yep.
So how would a person look into that? How do you figure out what expenses each type of property would need? I guess experience probably helps you, and if you know the areas and the types of homes, you might have a better idea of what you need. But how do you start to get a grasp of that?
Sure. Well, the first thing is there's there are 5 regulars, right? There's taxes, insurance, vacancy, maintenance, and I'm forgetting one of them. But there's the standard 4 or 5 that everybody is going to have. You can kind of look at that. The other thing I do is talk to local landlords. They know what expenses are going to be. And there's 28 million real estate investors in America, and so pretty much you throw a rock at somebody and you got a chance that they own a rental property or 2. There's a massive amount of rental property owners in America that people don't even know about because nobody talks about it. So chances are you can find somebody local in your area that has 1 or 2 or 3 properties and just talk to them. Hey, what are your expenses every month? What are you dealing with? I think that's probably one of the best ways to just nail down those expenses on what you're going to be dealing with. And again, then bring in the 50% rule. If you're not sure, you can always kind of fall back on that until you do know more.
Now, you talked about these low FHA loans and how you made your first home buying experience at 21. I'm going to guess that you weren't independently wealthy at 21.
No, I was like, okay, I was 21. I was making like $8 an hour, $9 an hour. Had no credit, no income. I mean, barely. Just started a new job, and this is before the real estate crash. So like, I go to the bank.
I was just gonna say,
yeah.
you're probably getting like 0% down offers.
Yeah, exactly. I go to I call up a bank, and I'm like, they're like, well, what's your income? I'm like, I don't make much. I'm this much. I'm like, okay, well, what's your credit look like? I got no credit. All right, well, how long have you had your job? Like a week. All right, well, we're going to give you a couple $100,000, zero down, go ahead. And like, luckily I didn't take advantage of the whole thing because, I don't know, like, I knew at least don't be stupid, don't max out. and then it goes back to your point, I mean, you guys talked about it a minute ago, but when you buy a house and it's so tight, right, like, that's what you do. Like, you're like, hey, the bank will approve you. I mean, they will tell you a number when you're buying your own house. This is what you're approved for. In other words, this is the most you could possibly ever spend and not go bankrupt. So what does every single person like in America do, and maybe Canada, right? They take that number to their real estate agent. They say, this is what I got. This is what I'm going to spend. And then the agent goes, of course, those real estate agents are like this. They go and find every property that's like 30% more than that, and they show you all these properties. So then you go to the bank and you push it a little bit higher, then you buy that property, and then all of a sudden you don't know why why your spouse has to work full 40 hours a week. And why you're out, yeah, it's crazy. Anyway, I could rant on that forever. We won't.
But obviously the times have changed. The economy has changed, and things have gotten a lot tighter. When we refinanced, we went through like all sorts of hoops, and it was almost more difficult, or I don't want to say more difficult, but they went through our finances with more of a fine-tooth comb than when we bought the house. So is it possible to get in without a lot of money now?
It is. I mean, it is. You have to have those things. Like, I think an FHA loan is a 620 credit score, I believe. So you have to have a somewhat decent credit score. Is it 580?
Okay. They'll let you go down to 580.
Nice. Okay. So 580, you can get in, which, most people have a 580. The income thing, they're going to want to see, they're a little more tight than they used to be. I think the number used to be, and if you guys know me, correct me if I'm wrong, but I think it was used to be like 40% you could spend of your income on your mortgage payment or something, and that's dropped down to, I think, 30 now. And depending on the bank, it might even be 28, depending on who you go with. So anyway, they've dropped those a little bit because they get that, hey, people can't spend. I mean, I heard banks back in the day going up to 60% of your income on a housing payment. Like, that just blows my mind that a bank would do it, but they didn't care. They had these things called no-doc loans. These were just hilarious, right? Yeah, you go to the bank, you're like, well, we don't like what you have, so we're going to do a no-doc loan, which means you don't fill out any paperwork at all. And it'll be great. It'll be just put down what you think you would like to make, and that's the number we'll use. It's just absurd, like absurd.
It was like The Secret banking, like just picture it.
Exactly.
Well, no, that happened when we were looking for a home. I mean, it was before the crash as well, and our entire income practically was just like my self-employed income. And we did go to one of these places, and they're like, oh yeah, we'll do a no-doc loan, and you could get like $500,000. We were just looking at it going, I think not. We went more, we did get an FHA loan, but we went with a different bank.
Man, I thought stuff was crazy in Canada. A no-doc loan. We'll just give you a $500,000 loan right now.
It's okay. Yeah. Oh,
you're
even
self-employed. You have no pay stub.
Yeah.
Here's
you will pay 9% on it.
Yep. Oh,
right.
Well, they went even more crazy like that. They would go like that. They would say, "Well, what's your house going to be worth? Oh, it's worth $100,000. We're going to give you 120. Take that 20 and go on a cruise." Like, they used to give you 20% more than your house was worth because the banks were like, "Oh, this party's never ending. House can be worth $200,000 next week," and they didn't. It's just, America was so stupid for like a few years. Yeah. I mean, I'm glad like I got in like as we were like looking over the edge, and I'm thankful I didn't get caught up in that. I mean, like, I'm very thankful I got in when I did and not in the 4 years earlier when every real estate investor was doing those 120% loans and taking the money and buying another property with a 120% loan and just doing this Ponzi scheme until the house of cards fell down. So crazy.
I actually had a friend who was getting into this real estate investing thing, but he was doing it the wrong way. Kind of what you were just talking about, taking the money from one loan and dropping it into another house. And he ended up with, I think, 4 or 5 houses that he had that he was trying to juggle, and he did it all at once. And, a couple of years later, he ended up going bankrupt. It didn't work out. It's if you don't do it the right way, it can be pretty disastrous.
Yep. And that's why
I think people have this idea in their head. They see these infomercials, on late night TV or whatever. That real estate investing, it's easy. You can make millions of dollars and have a Lamborghini just like me.
Yep.
They see these things. They think it's going to be easy, just easy cash flow, getting renters and having this extra cash flow every month. But it's not that easy.
Those guys drive me insane, right? There's so many of them. Like, when people think real estate investing, that's who they think of. The big hair, big car, big babes, in the back seat. And they're like, you can have all of this. And it's just like, that's when I tell people. So those are the two responses. When I tell people I invest in real estate, they go, "Oh, you're a slumlord." And I'm like, "I'm not a slumlord." or they say, "Oh, are you like the late night TV guy?" I'm like, "No, I'm not like the late night TV guy." Like, I don't know. Like,
I just buy Kurt Cobain's houses.
I just buy Kurt Cobain's house. You could have all of this. You don't want all of this. But yeah, real estate investing is not easy. It's not quick. It's not even fun most of the time. I mean, I like it because there's leverage. I love the fact that you can leverage your wealth. I love the fact that you can force appreciation, you can force equity, and you can trade like creativity for cash, right? Like, if I want to go buy stocks, there's not a lot I can do other than buy the stocks. I love that with real estate, that I can leverage my brain to make money. Like a business, right? Like, you all have your own businesses of some kind. Like, the fact that you can just use brain power to make money, it's exhilarating. That's what real estate you can do, and you can't do that in a lot of investing avenues. So there are good, and there is definitely a lot of bad.
Yeah, the leverage thing is interesting because I always like comparing real estate and stock investing, which is more my cup of tea, to quote unquote buy on the margin or use leverage in the investing world. Like, if you're leveraged like even 30%, people are like, "Ooh, you're an aggressive investor," and then they go take out, like you say, 97% of their home equity is borrowed money or whatever the case may be, and everyone's like, "Oh yeah, well, we have a mortgage on that."
Well, the nice thing is that with real estate, right? Like that. Like, if you don't pay it, you're like, "Oh, well, I'm just not going to pay it," and you just take the house back, right? And like, that's why everyone's like, "Oh, whatever, with leverage, I don't have to actually pay that money," which is a terrible philosophy, but that's what people do. They're like, "Oh, whatever, if the market goes down, I'll just give the house back. Who cares? Who cares about my credit?"
That's if they'll take the house back.
That's if they'll take the house back. Yeah, there's a lot of then you can have fun stuff with short sales, and you get all those other fun adventures. But yeah. So.
Well,
anyway.
there are some states, though. There are some states where even if they've foreclosed on you, they can still sue you.
I've heard that too. Yep.
I mean,
they
it
can
just
come after
depends
you
on
later on.
it depends on the state law. So.
Yep. And then you got to declare bankruptcy to try to get away from that, and now you just ruin the next 10 years of your life. And,
That's right.
yeah. So again, everything I always say comes back to like, buy conservatively. If you're going to invest in real estate, do it better than the 90% of people who don't do it. And I guess the same could be said for investing with anything, right? Like, if you're going to do it, don't half do it. Like, do it. Like, learn to do the math, learn to do the numbers, whether you're doing stocks and you got to learn what the sheets are and all that stuff that I have no idea about, that I'm, relying on you guys to do for me. Or, like, learn the math on how to analyze a property. Like, it's not that difficult, and there's enough, free information out there all over the place that you can learn how to do it. Take the time to learn how to do it and then do it.
So, Brandon, if you were investing in like 2005 or 2006 when the market was really hot in the States, because that's essentially where we are in Canada. The Bank of Canada just came out today and they said they thought that the Canadian real estate market was 30% inflated on average. And I think they're probably lowballing it for our major urban centers, just as a personal opinion. And I was just playing around with the numbers, the rules of thumb that as we were talking, and there's nothing even close.
Yeah.
Like the 1% rule, we're not even in the ballpark, like maybe 0.5%. So is there ever a market or a time period such as like 2005 or 2006 when you'd be like, no, just sit on it, don't rush into it, don't buy into the craze or whatever?
Yes. So a couple of thoughts on that. One, real estate is very local. And so, where in Seattle right now, the 0.5% rule is all day. LA, 0.5% is the best you'll ever get. Probably like 0.2 is more likely. Like, you cannot cash flow in some areas. fine.
Right.
But I always say, like, within, at least in America, I don't know Canada, but at least in America, within a 2-hour drive of any location in America, you can find good cash flowing properties. If you look, like, I mean, I live an hour and 40 minutes from Seattle. I can get 2% deals every day here in my area. Do Seattle people come down and invest in my area? Hardly ever, right? Like, even though I talk about it, like, every week to, like, thousands of people about my area, nobody invests in my area because people just don't want to invest out. And I understand, I don't want to invest at a long distance, but 2 hours is like getting your car, listen to some podcasts like your guys' and you know, you're there, and you got some education on the way. But people don't do it. So anyway, that's my first thought is it is local. You know, you can always do that. And secondly, yeah, if the math does not make sense, yeah, I see no reason to jump in. The real estate market goes like this, right? You just, you know, if it's going up too high and you can't get those numbers, don't worry about it. Stick your money in something else that isn't at that point in the market. And, you know, when it comes back down again, have fun, go buy. I mean, that's what we did for the last 5 years have been like, or 7 years now, have been like a, you know, Kmart blue light special for real estate investors. I'm like grabbing things off the shelf and like fighting old ladies. It's been amazing because like everything's on sale and everything's fun. But now like it's no longer on sale. Now everything's more expensive, and I've severely scaled back in the past year. Just saying, okay, I'm only going to look at properties that are amazing deals on paper, and, you know, doing a conservative analysis. Then I'll move forward maybe.
What makes something an amazing deal or a worthwhile deal? How do you do that due diligence and know that what you're buying is going to be worth it? You know,
Sure.
I mean, when you buy a house, I guess you have the engineer come in and tell you what it's worth and so on and so forth. And even then, it's not always very accurate. So as a real estate investor, how do you make sure that you're not buying something that's just a house of cards that's going to fall apart once you buy it? You know, how do you know that you're going to get your value out of it?
Sure. I mean, so I guess a couple ways to look at that. One, I don't care as much about equity, obviously, as I do cash flow. And cash flow is a lot easier to predict. So that's the first thing. I mean, equity, I like to say, is the icing on the cake. If you get it, awesome. You know, right? If my market shot up in value, I would love it. But I'm going to retire wealthy whether or not my market ever appreciates 1% over the rest of my life, because I bought it, you know, based on the cash flow and based on the other avenues. Appreciation's only a bonus. So first of all, invest for today, not for tomorrow. You can tweet that, people. Secondly, you know, sometimes you don't know what you're getting into. Sometimes you open up a wall and you find out the entire house was built with like asbestos cedar, which isn't real, but like, you know, like, you know, like you find like these problems and that sucks sometimes, right? But it's very, very rare. Those kind of things where they're like completely like, oh my gosh, I never realized this, are really rare. And even if you do find them, usually they're not that expensive. It's not like their house was built out of asbestos probably. And to prevent against that, or to hedge against that anyway, you probably just want to get a good inspection done from, you know, a reputable inspection company, not just your brother-in-law who happens to be a contractor, or, you know, who knows he owns a hammer so he can come look at your house. You want a reputable contractor who can come in and actually do it. So, I don't know. Those are a couple ways to hedge it.
Those are like HGTV pause points. Like those are commercial breaks where they like hit into the wall and everyone's like, "Oh my god!"
Exactly. I know. Back after this. Exactly. Yeah. Yeah.
There's a dead body in there.
That happened like 2 weeks ago. 2 weeks ago, I read this article about this real estate agent showing a house, and he opens up this like closet door, and inside is a dead body laying on the ground. Like that actually happened. Not in my house.
So, how do you find these good people to work with? How do you find a good engineer, a good lawyer, a good accountant, good realtors, good people to manage the property if you're doing that? Like, how do you know that those are the people that are going to do right by you?
Sure. So one of the best tips I ever heard, it was a while ago, I don't remember who said it, but I thought it was just an amazing idea. They said, ask the person who they like when you're working with anybody, ask who they like to follow. In other words, you know, if you're hiring an accountant, who do they like to get the lead from? Like, what attorney does the good work that they like to get? Okay, well, that's how you get your attorney, is by asking the accountant. How do you get the accountant? I don't know, ask the guy that comes before that. At some point, you have to start with somebody, though, right? I would start with a local investor, somebody who's doing it already. Because, you know, you don't want to hire the guy who did your, you know, brother-in-law's divorce to do your, LLC paperwork for your property, right?
Well, that would
Like,
mean
that's
you divorced your sister, so you really shouldn't talk to
You really shouldn't. Yeah, you don't want to deal with that. So instead, you want to deal with, somebody who's doing that for other people successfully. And real estate, honestly, real estate investors and everybody, not even just real estate investors, everybody loves to brag about who they use. Right? Like, I love to tell people about my accountant. Why? Because I look better to my accountant then. My accountant's going to give me discounts. She's going to like me better, going to be quicker. She's going to do me favors in the future because I'm helping her out. So I tell everybody, and people ask me a question, hey, who do you use for this? Boom, I'll tell them because I know it makes me look better. So again, referrals all day long from people who are doing what you're doing or want to do.
So do you say most local areas are going to have some sort of a real estate investing group or something like that, a meetup group or something along those lines that meets on a regular basis? Or
Yeah, I mean, more or less. I would say most areas have something like that. Now, here's the problem with most local real estate clubs is they make their money off bringing in the late night TV guy who comes in and does a presentation and he says, "Hey, everybody, you can have all this." And he's like, that's where they make their money. So they're not really networking as much as they are. Let's all, whatever. Yeah, let's sell some product to you. That said, investors do show up to those things. I'm not saying you shouldn't go. You can probably find out really good information. Just leave your wallet at home and, do the Oprah thing as the next day. If you still think you want to buy it, then consider it. Maybe. I don't recommend it, but, yeah.
So along those lines, I mean, a lot of people also look into investment clubs for real estate investment clubs. Like, how do you feel about that? Is that something that's a real idea, or do you prefer to just kind of go it alone and make sure that you are getting all the profits and that everything's in line?
Hard to say. I mean, I like the idea of working with other people. If that's what you're referring to, right? You work with other people, pool money, somewhat.
Right. Yeah.
I do like the idea, first of all, of pooling money in some kind. I like partnerships. I do a lot of partnerships because I find it, if I lack the cash, and this goes back to the what do you do if you don't have a lot of money. If you lack the cash, somebody else probably has the cash but doesn't have the experience or the willpower or whatever. And so you work together and you can make some cool stuff happen. I'm a huge fan of that. That said, I mean, if you have money to invest a little bit, I don't recommend necessarily just going out and giving it to somebody because they look like they know what they're doing. Then here, you take care of it, right? Like, you don't want somebody else taking care of your money. So if you're going to do an investment club like that, get people together, make sure that you know every single number that's happening at all times. Make sure that it's not some secret or that you have all your faith in one guy, because I don't know what the statistics are, but I would guess that 80-90% of real estate investors probably fail. I mean, or at least don't make a lot of money. And so you don't want to be that guy that's failing. I actually would be an interesting number to find out really what percentage of people actually lose money in the real estate game, but it's probably, at least with the flippers and stuff, it's probably pretty high.
Now let's talk about tenants.
Sure.
Besides
fun.
just the house falling apart, we already talked about that, and you said it's pretty rare.
Mm-hmm.
It seems like tenants could be something that's just a hotbed of horror stories.
Yeah.
So how do you deal with that? I mean, I'm sure most people out there who are renting are good people, and it's
They're
easy.
not.
Your faith in
Well, there you go.
has been destroyed.
They're awful people. Yes.
How do you screen good people? How do you get good people in? How do you keep good people happy that they stay? And what do you do about all the bad people that come in?
Sure. Okay, so first of all, you are right. Most people are genuinely good. Most people out there. The 80-20 rule, that Tim Ferriss popularized, and he didn't invent it, but Pareto's principle, right? That 80 applies perfectly well to the tenants. 80% of them are going to be perfectly fine. 20% of your tenants will cause you 80% of your problems, and probably more severe. I would say 91% of your tenants will cause 99% of your problems all day long. So I discovered this 2 years ago, and I'm like, get rid of the 1% then. I mean, that it's really that easy. So I just started doing that. I get a bad tenant.
A progressive reality. Get rid of the 1%.
It does.
The whole
Down with the 1%. Yeah.
Your pitchfork.
Yeah, get rid of the 1%. not in that kind of 1%. But yeah, I mean, I would just start asking people to leave. I mean, we typically don't sign a lot of long-term leases because I want the ability to tell people to leave. Now that's slowly changing as I'm getting better at screening and stuff, which I'll get to in a second. But I have no problem anymore just being like, hey, Sally, this isn't really working out too well. You don't seem to be doing well. I'm not doing well. You're not paying rent very well, blah, blah, blah. Let's just end this and move on our way. I've done that. I've even paid a number of times. I've paid tenants to leave if I know they're going to be a problem. Like if I have to evict them.
That's a great idea, actually.
Yeah, I love that idea. So a typical eviction's $2,000. If I got to pay my attorney, it's going to be $2,000. I'm going to lose 2 months of rent. There goes another $1,000. I'm going to lose $1,000 to repairs because on their way out the door, they're going to bang up everything and wreck things. I'm going to be out $3,000, $4,000, $5,000 at the end of the eviction. So I go to Deadbeat Dan and I say, hey, Deadbeat Dan, $500 right here if you're out by Friday and this place is clean as a whistle. Is that a phrase? I think that my parents used to say that. Clean as a whistle, right? $500 yours. It's going to help you move out. Blah blah blah. They take it almost every time. I've only had one time where the guy just flat out didn't take it. So that's now I don't have to spend not $5,000, it's $500. And the great part is that was his security deposit anyway. Like it's not like he cleaned the property. Yeah, I don't get to keep the security deposit. I give it back to him or whatever. But essentially he gets to go on his way. He's happy because he doesn't have an eviction on his record. He saved his credit. I don't have judgments after him. Great. And I'm happy because I got a nice unit back. Yeah, it hurts the pride a little bit to give a Deadbeat Dan $500 or $300 or whatever, and he's just going to go spend it on drugs anyway most of the time. I mean, it's sad, but that's exactly what they spend it on. Like, every bad situation I've had has been a result of drugs, first of all, which goes back to the screening thing. The screening is the most important thing you could do as a landlord. Once you have the property, you've done your math, that's the first important thing. Now, screening is the other most important thing you could do. You can tell so much about a person up front, but nobody ever does it. I mean, I've been a landlord for 8 years now. I've had like 3 people ever call me and say, can I get a reference for this tenant who used to live with you? Like, I've had probably 100 tenants come in and out of my establishment, yet 3 people have ever done a background check and called to find out if they were good tenants. Like, doesn't that just seem like the most obvious thing? If you want to find out how a tenant's going to be, shouldn't you call their old landlord and say, hey, how were they? Like, wouldn't that be like the best indication of how they're going to be? Yet nobody does it. Nobody does it. It's insane. So anyway, check with their previous landlords, run a credit report, make sure that they make enough income. I do 3 times the monthly rent. So if the rent's, $1,000 a month, they have to make $3,000 a month, or I will not rent to them. Not 29, not 29.9, $3,000 a month in rent. And that is my number I have to stick with. And if they don't get it, they can, get a cosigner or whatever. But by being strict up front, it's not being mean, it's being helpful to those people, because science has proved it, experience of millions of investors have proved it, that you don't want to rent to people because they will end up evicted on the street and more broke than you started. So don't be nice, don't rent to somebody because you like them or because I had a sob story. Rent to them because it made a financial good sense to do so.
Do you find any one thing are the best indicators of who is going to be a good tenant and who isn't? It's just a combination of all.
Yeah, no, not so much good. I mean, sometimes obviously people that are responsive. I want to see that they're responsive. I want to see that they answer their phone when I call, or at least call me back. But typically, the good ones, I don't know, they're kind of, like I said, there's a lot of good ones, but red flags for bad ones, those are easy to point out. Again, if they don't return your phone call, if they say, oh, I don't have a phone right now, or you call and it's disconnected, that's a really good indication that something's wrong there. You can't discriminate against certain things like number of kids, and you don't want to do that because you'll end up in a lot of trouble, but you can look at things like household size. If they've got 8 people in their household, and it's a 2-bedroom apartment, you can tell them, we have a limit of 2 people per bedroom. Because having too many people is the red flag for your property is going to look like, I don't know, a tornado went through it in a week. And so again, you can't discriminate against kids. I'm not advocating that, but having too many people, in my state, I think it's 2 people per bedroom. I think most states are like that, I think. So that's important to look for. A lot of times, probably the biggest red flag is being in a hurry. It's like, I need to get into a place today. tomorrow. I've got the cash right here. I need to get in today. That never works out well. Never works out well. Because usually it's because they're being evicted and they don't want to pay that guy, the money, so they're going to give me the money instead. And it's not yet on their eviction record because it's not gone through yet. They're trying to get in. I mean, usually the hurry is always a problem. The people that are like responsible and they got their ducks in a row a month ahead of time and they're not looking for a place the last day, those are the ones I want to rent to.
When you look at credit history, you running credit scores on that also?
We used to not do credit because I had this theory that everybody in my area has bad credit. We rent to lower income people, not like the lowest, but like pretty low, blue collar workers, and they all have bad credit. I mean, everybody has a medical issue, it seems like, and their credit's wrecked. So I used to say, well, whatever, they all have bad credit. But lately I've been actually tightening up my standards quite a bit, and now I run credit, not necessarily like a score, but there's a number of services out there that will give you like a range, like they're in the green or they're in the red or they're in the yellow. Because I'm not an actual like credit authorized person. I didn't go through all the credit classes to be able to officially run credit. So usually there are companies that will kind of do that. But here's why I switched. Somebody told me on a podcast episode, they said that like just because a person doesn't, if you do a background check on like criminal, right? Just because they don't have a criminal record, all that means is they didn't get caught. You don't have to try that hard not to get caught. So that doesn't tell you much of anything, right? I mean, if they got a bad criminal record, then you know they're bad. But just because they have a good criminal record doesn't mean that they're a good tenant. But credit, you have to actually try to have a good credit score. You have to be a good credit-worthy person to have a good credit score. It's not accidental like the criminal is. So that's why now we run credit, and we do require at least halfway decent, like the yellow or whatever it is. Yellow or green. We don't let the red credit in anymore. So
that's good to know for anybody out there, and they're wondering, whether they need a good credit score, a good credit history. What is it useful for? Well, if you ever plan to be a tenant in one way, shape, or form, that's where it could come back to bite you. I know I've had landlords ask me for credit, and it was just, all right.
Yeah. Yeah, definitely more and more as more and more landlords are kind of getting with the program today, and I think a lot more are starting to screen better. That's going to become more and more of an issue in the near future, and it becomes easier to do it online. You no longer have to, it's not like you have to go to some weird bank. But as that progresses, it's going to be more and more important for people to have good credit when they're trying to rent a place, especially in a hot neighborhood. If you're in a city where it's hard to find a good rental property, you got to compete with all those other people. It's really, really important at that point to have a great credit score so you can kind of outbeat everybody else.
Oh yeah, well, we just moved across the country, and well, I don't even get to say that anymore. We've been here like months now, but yeah, we had to go through a credit score thing. They had to get our pay, everything. They did this big screening process before they would even let us into this rental apartment place. It's nice, but I think you make a good point. I mean, if you want to go somewhere that's a little bit nicer and be able to rent from someplace you want to live in, then yeah, you do need to have that credit.
And exactly what you said there. If you want to rent a nicer place, I mean, if you want to rent a place without them doing a credit check or without them doing any sort of thing, like it might not be the best place. You can find it. Sure, there's lots of people that can rent to you. But if I was a tenant, I would not want to rent from somebody who didn't do a background check on me, because it means they didn't do a background check on my next door neighbor either, or the guy living above me, and that would freak me out. I don't want to know. I want to make sure that my neighbors are good as well. So there's a tip for all the renters out there.
That's a good point. You want to know who your neighbors are.
Think about that, but now that you said it, I actually feel much better about where I'm at.
Yeah.
So you certainly laid a lot of information on us here. Besides maybe underestimating what your expenses will be for a beginning real estate investor, what else might they need to know that they might not, what kind of surprises are out there for them that they wouldn't expect, that an experienced investor would know?
Well, one of the big things when people want to get into real estate investing, the big things that they come across with, we call it like analysis paralysis, and it's in a lot of industries, but like the idea of, I mean, if you can see behind me, right, these are all books for the people that are watching the video. Like those are all books. Most of those are real estate books. Every one of them has a different like strategy.
Twilight.
Okay, there are a few of my wife's. Okay, right here.
rent
This-
to
Oh,
vampires.
Yeah, don't worry. This
Actually, you
section
should
are the
rent to
girl
vampires
books.
because they're rich.
They are rich and they don't sleep, so they're not gonna, I don't know, wreck your house. Anyway, funny. Actually, I live near Twilight, where that whole thing took place. So
I'm so
like,
sorry.
I know. We actually Anyway, our area is tourist area because of Twilight. Like people travel through and they come for Kurt Cobain and for Twilight. So anyway.
So, how are you not
Anyway.
using this house as a
Can I just
museum?
tell you?
Sad
I've been
stories.
so there are two things that are disturbing me about your Twilight books back there.
Yeah.
The first one is that they're out of order, and the second one is that I know that they're out of order.
That is funny
This is
that you
very
know that.
disturbing to me that I know that they're out of order.
I will tell you, I read the first half of the first book, and I could not do it. My wife was like, "You gotta read it. It's so good. I love
They're
it."
terrible.
No, they're terrible. It was a
I read
terrible book.
all of them, and in
Twice,
the third
right?
one, no, and in the third one, there were several times where I was like, I don't know if I can do this. And my husband's just like, just stop. And I'm like, but no, I've never not finished a book.
Yeah, this is
will
one.
do
That's
this.
one of two books I've ever not finished in my life. I just could not do it. It was. Anyway, I don't know. I'm just
I'm sorry. I'm
offended
sorry.
half of the audience here.
I
It's a
think
Miranda
the
test.
lesson there is if something doesn't feel right, it's okay to walk away.
That is a good tip. You can tweet that right there.
I'm trying to say get back in.
Okay, so yeah, bring it back in. So most of these, or a lot of these, are real estate books and vampire books. So the real estate ones, people get into it and they're like, okay, I'm gonna be a real estate investor. Then they look at that and they're like, oh crap, what do I do? And they're like, oh, that looks fun, and that looks fun, and that looks fun, and I'm gonna do this. And then 5 years pass and they haven't done a thing. Nothing got done because real estate is so massive. It's incredibly massive. I mean, there are hundreds and hundreds of different ways you can invest in real estate. So people, that's the first thing you're going to face when you're trying to get into it is, oh, what do I do? Where do I even start? So what I always advocate is pick a niche and pick a strategy. I think that's a good way to look at it. So pick a niche would be what do you want to do? Houses, multifamily? Do you want to do commercial properties? Do you want to do mortgages? You can actually invest in mortgages. Pick a niche and then pick a strategy. What are you going to do with that? Are you going to flip it? Are you going to rent it? By thinking of it in those terms, it becomes a lot more simple. Oh, okay, I want to flip single-family houses. Okay, I want to rent small multifamily houses. Well, now you don't have a whole bookshelf to try to learn how to do something. You've got one strategy, one niche. Okay, well, I'm going to find somebody who does the rentals of multifamily properties, and I'm going to learn from them. Or I'm going to read a book on managing and buying multifamily properties. So that's one thing that people will encounter is just an overabundance of information and confusion and fear and, oh no, what if I get this wrong? So that's something to watch out for. There's a lot of stuff, I suppose, but there's a lot of people willing to take advantage of you, and you can get that kind of anywhere. But yeah, a lot of people that want to, sell you on some crazy course or boot camp where you can go pay get a free weekend boot camp, and then they upsell you to a $300 one, which then they try to get you to the $10,000 one, and then they try to get you to the $50,000 one, and then there's a $100,000 coaching, and then it goes and goes and goes, and those are so prevalent, and you will see those sharks try to get you, and anyway, just fight them off. My theory with education is you can do it. Okay, the kind of person that can succeed with a course or a boot camp or whatever can succeed without. The kind of person that can't with one can't without. So I don't see a lot of value in spending tens of thousands of dollars unless you have if I was had a lot of extra money and I didn't want to whatever, I could pay somebody to help me, fine. But anyway, that's something to just watch out for. There's a lot of shysterness that goes on in this industry. So watch out.
Sounds good. So I think we're going to wrap up here, and we'll go around our panel here and do a final word on real estate investing, and just to just bring it all back home. So Kyle, what's your final word on real estate investing and getting into it?
I'm certainly no expert on real estate investing, but I know not to bite off more than you can chew for your first go round, and I think Brandon made some great points just talking about get into it, read as you go, educate yourself, and be careful so you don't end up like Peter's poor buddy there that sort of bought at the wrong time and bit off a little more than he could chew.
Yeah.
And Miranda, what's your final word?
Yeah, so don't look at your home that you live in as an investment. I mean, we all know that it's just horrifying. Anyway, but but yeah, and then also remember that there are ways to invest in real estate without having to buy property. I actually really enjoy. I am investing in a REIT right now.
Nice.
And it pays a dividend, and it's wonderful, and it adds a little bit of real estate exposure to my portfolio, but I don't have to worry about being a landlord or like owning the property. So I like that, and until I get a little more comfortable with I'll never mind. I'll be investing in REITs forever. So.
And Peter, what's your final word on investing in real estate?
Well, I guess my final word, it's something that I haven't really delved into too much as far as I don't own any rental properties or anything with my wife currently. But in looking into some of these things, it kind of has come down to that you really need to have your financials in order before you kind of start jumping into this. Make sure you're in a position to invest in a real estate property, have emergency savings ready to go in case things do go wrong, and be ready to work hard if you do get into this, because it's not going to be an easy overnight success with babes in the back seat of your car, like Brandon was saying earlier. It's going to be a lot of hard work, and you need to be ready to network and find a mentor possibly. But in the long term, it can be a great way to cash flow your retirement and retire wealthy, basically. So there you go.
And Brandon, if you'll give us a final word on investing in real estate.
Sure. I'm actually going to branch off what Peter said there. Find a mentor of some kind. And again, like, it doesn't mean paid mentor. Like, find somebody who's doing what they're doing. When I got, I think I had like 2 properties. My best friend was renting this property, and he was going to go do some work for his landlord. So I went with him just to meet the landlord. I met him, talked to him. He ended up becoming one of my best friends to this day. We do a ton of jobs together. We work together all the time. I looked after his properties for years. He's got me financing. He's got me all sorts of stuff, and I learned a ton from this guy. Never paid a penny, right? Especially guys and girls that are young. Like, old investors love to teach like the young, excited people about real estate, about what they've done. And not just in real estate, but that's any field in the world. Old people love to teach young people what they've done. Like, older people, I'm not even talking old, like 40 plus, right? Like 50 plus. Their kids don't care about real estate. Their kids don't care about, their kids are out whatever else. Like they're alone and they're like this little island. So like this young person comes up, they're like, oh, like I see myself at your age. If only I was young, like, and it doesn't matter how young you could be 40 and that person could be 60. It doesn't matter. Like, they see a younger person and they want to help and take advantage of that. Learn from those people. Take them out to coffee once a week, and you'll grow immensely fast and stable. So.
Thanks a lot for coming here and telling us about real estate investing. Now, you work, or you have a particular site called Bigger Pockets that happens to work with a lot of real estate investors. Why don't you tell our audience a little bit about what they do?
Sure. BiggerPockets.com, we call ourselves the Real Estate Social Network. So we've got 230,000 members on there. We have a podcast, the Bigger Pockets podcast, which is as of yesterday, thanks to the FinCon group, it was the number 8 or 7. We got the number 7 best ranked business podcast on iTunes, which was exciting.
Nice.
Yeah, that was pretty. I want to get higher than that, but whatever, we'll get there. It's a popular show. We got forums, blogs, whatever. I talked about earlier about the idea of talking to people who know the stuff, know your area. That's a good place to do it, honestly. It doesn't cost you any money. It's free to join, and you'll find people with 220,000 people. There are people in your town who are on Bigger Pockets that you can connect with and talk with, and they're that old guy that's going to share with you information sometimes. So anyway, that's kind of the gist of BP, is we just hang out and we help people become more successful real estate investors.
Sounds great, and definitely worth checking out if you have any interest at all in investing in real estate. Thank you again, Brandon, for coming and sharing your knowledge with us, and thank you everybody out there for watching and listening. Till next week, be good with your money. Bye-bye.
Thanks for joining us on the Money Mastermind Show. Get more information at moneymastermindshow.com. Don't forget to subscribe to the show on iTunes and YouTube, and follow us on Google+.